Hey all, welcome back to the GMT channel. We are running the series on private equity interview question. So today's topic is tax haven country for PE. How PE fund earn more with saving a tax. So how they earn, we'll discuss in this session. So be focused. This is an important topic in perspective of a PE. Ever wonder how big private equity firm like Blackstone, Carlyle Group manage to keep more of their profit? The secret is tax haven. But they smart financial planning and compliance nightmare. Let's break it down. How they manage, uh, we have to manage. So they take some strategic decision to register their firm into the tax haven country where tax is zero or minimum. Welcome back to the channel. If you are finance, private equity, or just curious about how the rich legally avoid tax, that's hit the subscribe button. Because today we are diving into the tax haven, into the private equity, and why they matter. So, what is tax haven? First, we understand this. So, tax haven is a country where the low and zero tax are on income, capital gain, investment income. PE fund loves their jurisdiction and because they help to optimize tax structure and maximize investor return. Like Cayman Island, Bermuda, and Luxembourg are the country who are the low interest, low tax and zero tax benefit for the PE fund who register there. So there is an impact in financial statement. Yes, there is an impact in financial statement as well. So lower tax, higher internal rate of return (IR) will be more capital reinvestment, better fund performance will be there. Attract investor looking for the tax efficient structure as well. Anyhow, it's benefit if companies PE firm giving low tax on their income or whatever they generate the profit, then the whatever the profit remain from after deducting the low tax or something is directly distributed to P investor, and the P investor the fund will grow much more better than before. So there is some accounting exception. Yes, there is some accounting exception as well. So government are too happy. Government are not too happy about the missing out the tax revenue. Regulation like OECD, BEPS initiative are cracking down, forcing PE fund to disclose more about the offshore structure. This means increase in scrutiny on the fund structure, more transparency are required in the financial report like this. So government is not giving the free tax on this basis. They have some limited guidance also they have to follow up, and the PE fund need to submit all the document what is required. So they sometimes do the scrutiny as well what PE firm is saying that they earn this much profit. If this much profit is not there, then they have to pay the penalty as well. So some structure has been decided up to this level, there will be the zero tax. Up to this level this may be 5%, or this level to 10%. Accordingly the profit and the capital gain should be reflected by the PE fund. So there is some transparency between the financial report will be compulsory. So it is possible in the real world. Yes, it is possible. Take the Blackstone and Carlyle Group. This PE fund giant use tax haven structure to legally optimize return while staying compliant with the global tax law involved. Even they are adjusted to their strategy also. So while before all the things will be gone, so everything should be pre-planned before launching of the fund, before investing into the fund of the PE, and what how they register. So it is a pre-plan, and this accordingly the fund will be running. So we'll take an example of this as well, how the PE fund earn the profit by reducing the tax liability. So this is an example of the how they earn the PE fund with the tax benefit. So a PE firm based in US might set up a subsidiary in the Cayman Island or Bermuda to benefit the favorable tax treatment on its return. Let's say US based PE firm earn 10 million in investment return. If the tax in the US is 21%, they own 2.1 million in the tax. Means they have to give 2.1 million in tax. But by structuring a subsidiary in the Cayman Island, where the tax is zero, they can be legally reduce their tax burden and reinvest more on capital. So this is the example that we have given. So investment return is 10 lakh dollar, and 21% is the tax rate. So around 21 lakh is going around the tax paid, and net profit will be the 79 lakh dollar. But however, the Cayman Island give the 0% tax, and all net profit will be distributed among the investor, or maybe reinvest into their PE fund. This is why the PE firms set up offshore entities to legally optimize tax efficiency and boost investor return as well. So this is how about the how the tax liability will be given save, and how this tax haven term will be used. If you are more interested on like this term, please hit the subscribe and like button, because we are running around more than 100 videos on the private equity interview question. So if you do not hit the subscribe and like button, so you will not get a notification. So thank you so much for watching. We'll meet you on the next part.